Welcome to the ultimate guide for trading stocks and options for income and profits, reading the mind of the market. My name is David Valliere. I'm going to go into a little bit about who I am in just a little while. But basically, this is a 40-year study of the stock market. And what I want to do is give you some really important background information before we get started. And the reason for this course, I really believe in the scientific method of inquiry, and I use the ideal model, which you see in front of you. Bransford and Stein in 1984 suggested that using the ideal model for solving problems in science, their approach to inquiry-based learning employs logical sequencing of procedures that begin with the problem identification and concluding with a reflection of an attempted plan of action. And that's exactly what I'm going to provide to you today. First, we're going to identify the problem. We're going to define and represent the problem. We're going to explore alternative approaches. And then we're going to look for an action on a plan that we can use in order to profit from the markets. And then we're going to look at the effects of that plan. All right, let's get started then. We're going to identify the problem first. And really for all traders, and I don't care how old you are, whether you're 18 years old or 28 years old or 38 or 48 or 58 or 68 or 78, it doesn't really matter. The problem is the same for every single one of us who trade the markets. And that's how to anticipate market direction with confidence and then take action, typically with a trade that would result in a profit from the anticipated movement, and do it consistently, reliably, and profitably. And that's exactly what the problem is, because you can't. It's very rare to have a method or a system in the market that works consistently and reliably, and then also profitably. And it's really also rare to anticipate market direction with any kind of certainty or confidence. And I'm going to show you a method that I've been using, that I've developed. In fact, I started creating this method back in 1992, and I've used it on and off. But I have done a tremendous amount of research on it, and I believe it will convince you also that this method is probably the most effective and most efficient method to trade stocks and anticipate market direction than anything that you've seen before. So let's define and represent the problem then. On the surface, the market appears to be a randomly generated fractal. So if that's the case, how do you anticipate the moves of a fractal? Well, it's really difficult. Our representation are the charts in front of you. Movement in stock prices appears to be random in both figure A and figure B. Figure B is a computer-generated fractal. Figure A is an actual line chart of the stock market. Now, if you take a look at both of those, they look extremely similar. And so you could say that there is some anecdotal evidence that in fact the stock market is random. But we're going to look at E, which explores other approaches. So we're going to explore alternatives to the problem of anticipating future market prices. In other words, if stock prices are not random or a fractal, what creates movement in the market? We haven't ruled out the idea that stock prices are not random, but we're going to look at some other alternatives to randomness or fractal generation. So, for example, one of the most popular methods of understanding stock market prices is supply and demand. In other words, if more people want to buy a stock, which is demand, than sell at supply, then the price moves up. If more people want to sell it, which is supply, than buy it, which is demand, then stocks go down. It's a very simple proposition. It's based on Economics 101, supply and demand. If there's very little supply out there and people want to buy it, the prices naturally go up. If there's lots of supply, lots of people want to sell it, and any particular stock or issue, and there's not much demand, then people will put it on the market, and the price will drop until it meets some demand. So let's take a look at two of these most popular approaches to understanding how the stock market moves. Number one, it's random and it's fractal. If the market was entirely random, though, then tragic events like the shooting of a public figure like the president or events like 9/11 would not affect the market in any way. But they do affect the market. In fact, if you take a look at 9/11, or if you take a look at the shooting of President Reagan or President Kennedy, then you would know that, in fact, markets can have events like that can have an effect on the market. If the market was totally random and a fractal, it would totally ignore that news, but it doesn't. So anecdotal evidence suggests that the market is not random or a fractal. So let's take a look at supply versus demand. Supply and demand is the most likely cause of market movements then. But what causes the supply and what causes the demand? Here's a little lesson in demand versus supply. If you've never heard of Silver Thursday, you're probably a little bit too young. This is what happened back in 1980. Nelson Bunker Hunt and William Herbert Hunt, the sons of Texas oil billionaire Harrelson Lafayette Hunt Jr., had for some time been attempting to corner the market in silver. In 1979, the price for silver, based on the London Fix, jumped from $6.08 per troy ounce on January 1st, 1979, to a record high of $49.45 per troy ounce on January 18th, 1980, which represents an increase of 713%. The brothers were estimated to hold 1/3 of the entire world supply of silver, other than that held by governments. The situation for other prospective purchasers of silver was so dire that the jeweler Tiffany's took out a full-page ad in the New York Times condemning the Hunt brothers and stating, "We think it is unconscionable for anyone to hoard several billion dollars worth of silver and thus drive the price up so high that others must pay artificially high prices for articles made of silver." And if you weren't aware of the time, it was pretty crazy. I mean, the Hunt brothers were on the news constantly. Well, they weren't being interviewed, but they were the subject of many news stories about the fact that they were buying a lot of silver. And in fact, like it says here, they amassed 1/3 of the entire world supply of silver, and that drove the price up to $49.45 per troy ounce. And so here's a lesson in supply and demand. Can individuals affect the market? Can they, by their actions, rather than have a fair market or a market based on some fundamental of silver or gold, actually affect the market by their buying and selling? Can one individual, or in this case a pair of individuals, brothers, affect the market simply by buying and selling? And for as large a market as silver is, you would not think that that's the case. But on Silver Thursday, on January 18th, 1980, silver reached $49.45 a troy ounce, which was 713% above its previous close a year earlier. And so you have to think carefully. There's a lot of silver is one of the largest markets in the world. And there are both suppliers and there are users and buyers all across the world. And two individuals were able to manipulate the price, or at least unbalance the supply and demand for silver to drive the price higher. There's another example of supply and demand that didn't quite work out in a different way. This has nothing to do with trading, but it is a market. Let's take a look at this report from The Hustle. According to recently uncovered documents, the sugar industry paid scientists in the 1960s to downplay the link between sugar and heart disease and instead place a blame on fat and cholesterol. The worst part, it worked. Reviews published by the paid-off scientists not only helped shape public opinion on the causes of heart disease, but even led to many of today's dietary recommendations. It wasn't until a few months ago, about 50 years after the fact, that the U.S. government pumped the brakes on the whole cholesterol causes heart disease narrative. During the mid-1960s, a number of studies came out suggesting that high sugar diets were responsible for America's increase in heart disease. The Sugar Research Foundation, known today as the Sugar Association, didn't like that. So what'd they do? Well, they casually slipped a few Harvard scientists about $50,000 each to write a review saying it was all a load of crap. The scientists, one of which would later become the head of nutrition at the USDA, followed through, publishing a 2-part review in the New England Journal of Medicine in 1967, stating that fat and cholesterol caused heart disease, not sugar. This review was directly responsible for the anti-sugar movement dying down and helped give rise to the low-fat diets most health authorities still endorse and recommend to this day. So obviously the fact that some very important people who were well respected in the nutrition field came out and said that sugar wasn't so bad for you. So it had a direct effect on the amount of sugar sold in the United States, because if they hadn't backed off from their position, it would have been a very different market. It would have been much tougher for sugar to become more mainstream like it is today, because if people thought that there was no linkage between sugar and heart disease, then certainly it wasn't so bad. And so demand continued to be strong for sugar. It's only now that we're starting to realize what the effects of sugar are, and I doubt very much they'd be able to do that today. But it is possible. Again, the lesson in history is that it is possible to manipulate supply and demand. Supply and demand is not just a matter of, you're willing to buy or sell at a certain price. Supply and demand can be manipulated, it can be shaped, it can be affected by participants in the market. And that's exactly what the lesson in supply and demand is here. We're going to look at both causes, and we're also going to look at some anecdotal evidence to the fact that the market is legally manipulated. Okay, let's take a look at some stock charts. Let's get right into it. Now, if you take a look at the stock chart, you can see it's a line chart, and basically, if you were to kind of just look at it in general and you knew that supply and demand was that caused the market to go up or down, then this leg of the market here, from this lower left-hand side up to this peak right up here, you would probably come to the conclusion that there was more demand than supply as the market continued to go higher here. And so every time that there was a peak in the market, you'd say, okay, demand was starting to peak out here, and then some supply came in. Maybe some people who got into the market early wanted to take some profits. And this is a typical way a chartist or someone who reviews charts and supply and demand would look at it. So they would find, for example, that this area of the market here suddenly found some demand. So there was demand coming into the market here. It drove the market higher, and we started to see some supply coming into the market here. And so that supply brought the market down a little bit. And so what happened was that maybe some people who bought at these levels down here wanted to get out of their position. They were short-term traders, so they got out of their position, sold. Some supply was available, and the market declined a little bit until it found yet more demand here. The market started to go up again until it found more supply, and so on. So demand causes prices to rise, Supply causes more supply than demand causes prices to decline. As you get to the bottom, more demand comes into the market, causing prices to rise, and that cycle repeats itself until we reach kind of the ultimate peak of the market, in which there's no more demand. Demand starts to diminish to the point where there's only supply, and the market starts to turn around and decline lower. Same thing in a declining market. You have a market in which there's more supply than demand, and so the market goes down, and the same cycle repeats itself for a market that's in decline. We have supply coming into the market, and that supply then, once it's exhausted, meets some demand. So there's a little bit of demand coming into the market. When that demand is diminished, when that demand is fully spent, then more supply comes into the market, and the market declines further. And then when more demand comes into the market, because the price is now lower, demand starts to drive prices higher. But let me ask you a question. Who are these people who are buying at the bottom of these markets? Is it you or I? Typically, a retail investor or even a professional trader will not buy at this point, at this very lowest point in the market. They're always going to wait for some sort of confirmation. It's extremely rare for a professional trader or a very good retail trader to buy at the very, very point at which the market turns around to go higher, especially in a move like this. So who is it that's actually buying here? I'm just going to leave that question open for now, but it's true for almost every single point on this chart. Who is the supply that is supplying the market here? Who halts the demand for stocks at this point, for this exact point, and then causes the market to decline precipitously? And in this case, it was a pretty sharp move lower. So who is it that's buying at these really important junctures in the market that halts the demand or halts the supply and halts the advance or halts the decline? It's a very, very important question. It's probably central to your understanding of exactly how the stock market works. And we're going to get into that right now. In 1963, a special study of the stock market was undertaken by Congress. The reason for the study was a sharp decline in the market in 1962. And Congress wanted to investigate the stock market and the exchanges and the securities market to help protect retail investors, the investing public at the time. And what they found was absolutely incredible. There hasn't been another study like it. And before you dismiss this because it was done in 1963, I will provide you with additional evidence that, in fact, it is still going on today. And the reason the report from this study is still as valid as it was in 1963 when it was submitted to Congress. The report, the special study report, especially in Part 3, goes into detail about individuals operating in the market at the very heart of the market called specialists. This is a page from the U.S. Securities and Exchange Commission describing exactly what a specialist is. A specialist is a person. Now, you're talking about an individual here who is a member of a stock exchange, such as the New York Stock Exchange, whose role it is to facilitate trading in certain stocks. Specialists must make a market in the stock they trade by displaying their best bid and ask prices to the market during trading hours. They are also required to maintain a fair and orderly market in the stocks that they trade. They do this, and this is very, very important, they do this by stepping in with their own capital to help reduce market volatility when there are not sufficient buyers or sellers. Now, This is also very important. The rules of the exchange prohibit specialists from trading ahead of investors who have placed orders to buy or sell a security at the same price. Only at the same price. That's very important. While the number of stocks a specialist trades depends on how active the stock trades, most specialists are responsible for trading 5 to 10 stocks. But actually, it can be much more. But there are a number of specialist firms. So the U.S. Securities and Exchange Commission is stating exactly what a specialist does. They facilitate trading. They make a market. They are required to maintain a fair and orderly market. Now, this is extremely important. What is a fair and orderly market? Well, quite interestingly, it's not defined anywhere. Let's take a look at one of the most respected members of the investment community has to say about specialists. John C. Bogle is the founder and former CEO of Vanguard Group, which you probably heard of as one of the largest mutual fund groups in the country. In 2003, on September 19th, he wrote an article called Specialist Man, and I highly recommend that you go and read the entire article, but I do have an excerpt for you here. Every security traded on the NYSE is assigned exclusively to a specialist firm. The specialist ultimately sees every order in its assigned stocks submitted to the exchange either electronically or through brokers on the floor. But while the NYSE grants specialists a privileged position in order to maintain a fair and orderly market, as I mentioned before, which curiously is nowhere defined, the specialist is also permitted to simultaneously trade for his own account, an obvious conflict of interest. The NYSE rules attempt to limit the specialist's ability to improperly use inside information by limiting specialists to trading only when there is a temporary disparity between supply and demand, buying when there are no other buyers, and selling when there are no other sellers. Yet if specialists really traded only when there was an absence of buyers or sellers, one would think they would lose money. The fact is that specialists are profitable. In Samuel Johnson's words, beyond the dreams of avarice. A forthcoming study will reveal that publicly traded firms with specialist units last year enjoyed pre-tax profit margins ranging from 35 to 60%. And to be honest with you, just a side comment, I think that's conservative. LeBranch, the largest NYSE specialist, generated more than $250 million in revenues, almost entirely from trading for its own account on the floor. Pretty profitable for trading only when nobody else wants to. This is really at the heart of what we're doing at Tradingology. The NYSE specialists and market makers and other market makers who operate at the very heart of the exchange are extremely profitable. Now, there are lots of traders in the market who lose money. In fact, on a retail basis, probably 97% or 98% of all retail traders lose money. Very few make money. But to make $250 million as an NYSE specialist, and I will show you later that LeBranch, remember this name, LeBranch has been in business for almost 100 years. Can you imagine being in business 100 years as a specialist of the New York Stock Exchange? The report of the special study of the security market talks about the specialists in quite a bit of detail. And I urge you to download the reports that come with this video so that you can read about them yourself. But let's just read this section. I've got several sections I'm going to read to you, but this one in particular shows exactly how they operate. The specialist and a free market. An exchange official testified that prices on the stock exchange over my years of experience are dependent upon supply and demand that comes into the market. There can be no doubt that this statement reflects the ideal of a free and open market, but it may not adequately recognize that the specialist himself has a significant impact on prices, perhaps even beyond that caused by his trading as a principal. It is important to identify and analyze the area of impact. whether and to whatever extent it is considered beneficial or detrimental. Even in providing price continuity, specialist trading affects the balance that would otherwise result from the free play of public supply and demand. But the impact of specialist activities on the market goes beyond this. To an extent not generally realized, the market on the NYSE is a dealer's market in which the specialist can at various times set and control the prices of a security. This again goes to the very heart of what we're trying to do at Tradingology. We are following the specialist. We are identifying his movements in the market. And so this special study of the securities markets from 1963 really does reveal a great deal about how specialist activities are realized in the market and what impact they have on the market itself. And the most important, really, there's a couple of really important sentences here. Number one is they are providing price continuity. Interestingly enough, prices that gap up or down is not a continuity in prices. And so we're going to talk a little bit more about that later, but it's also a very telling sign of what specialist activity is actually doing in that stock. Also, the specialist can at various times set and control the prices of a security. The events surrounding the opening illustrate several points. Okay, this section is in regard to an opening of a stock in which there was some discussion about how the stock should open. And this reveals how specialists operate when they open a stock for the first time. First, the specialist had wide discretion in determining whether to participate in the opening and to the extent of such participation. Let me just make a side comment on that, which is that the specialist, being at the very heart of the market and is ordered to create a fair and orderly market, would seem to indicate that they have to participate in an opening of a stock. But this is saying that specialists has wide discretion in determining whether to participate in the opening of a stock. All right, let's continue. Second, even when a governor supervises the opening, his role seems to be quite limited. In this connection, a former chairman of the board testified that it is up to the specialist to tell the governor where he thinks he can open, and doesn't tell the specialist because that would certainly be going far beyond any duty or power the governor might have. And these are managers on this New York Stock Exchange who is a governor who is in charge of floor trading. So the specialist has, and it appears to have, total control over how a stock opens. In the IBM opening, the governor involved was circumscribed by the fact that he had a large position in the stock and that he intended to participate in the opening if necessary. The exchange staff and the person of the executive vice president was seemingly concerned only with the mechanics of handling orders and not the substantive decisions. And here's the important part. It is evident that, in many circumstances, the specialists have power to set and control prices unilaterally. The decline of competing specialists removes the restraining effect that competition might provide and make it imperative that there be adequate surveillance. The regulatory program should include measures designed to preserve the arm's length quality of transactions on the exchange and should specifically include limitations on the specialist control over opening prices. That never happened. The decision to the actual, there was absolutely nothing following up on this that required regulatory oversight of how specialists open stocks. They still have absolutely free reign on how a stock opens. I'll read another section here, which is really, really telling. As mentioned before, the special study report stated that specialists have really total control over prices on the stock exchange. Another example of the specialist control over the market is disclosed in a floor department file. In this case, the specialist, when questioned by a governor and member of the floor department as to why he sold a particular stock at a certain price, testified as follows. Question: you supplied 600 shares at 43? Answer: that is right. Question: if you hadn't done that? Answer: I could have sold at any price. I mean, had I wanted to, I could have sold 100 at 43, 100 at 43 and a quarter, 100 at 43 and a half, 100 at 43 and 3/4, 100 at 43 and 7/8, and so on. And just done anything I wanted to. I just didn't. I figured 43 was equitable. There is something called a book. The specialist told the broker that the book was thin and the broker should try to get limits put on the order. We're going to talk about the specialist book in a little while, but basically when you place an order, a stop loss order or an order to buy a stock through your broker, the broker usually does not hold that order because by the time it's triggered, the price may change or vary to a large degree. Those stop orders are placed with a specialist who has a book, an electronic book today, but in those days it was an actual book, that the specialist was able to enter orders to either buy or sell at particular prices that were away from the market. So in other words, if a stock was trading for $50 and you wanted to buy it when it broke out at 55, well then he would know that you have entered an order to buy the stock at 55. If you wanted to sell, if it dropped below 45 or 40 and you placed the order to sell at 40 or 39 and 3/4, then he would also know that because it would be placed in his book to sell the stock at that level. And that's an important point to keep in mind as we continue. Page 138. The present system works to marshal all buying and selling in the hands of one person who can evaluate the situation and arrive at a fair price. Again, a fair and orderly market is what the specialist is tasked with. If this process were merely a matter of pairing off one order against another, openings would be routine and mechanical. If there were an excess of buy orders, the specialist could resort to the sell orders on the book and use enough of those orders to make up the difference. In such a case, under present procedures, the opening price would be the price of the last sell order necessary to arrange a balance of orders on both sides of the market. However, consistent with the exchange's policy of maintaining price continuity, the specialist is expected to trade for his own account when necessary to establish a fair opening price close to the prior day's last sale. And that's exactly what they mean by price continuity. Specialists have testified that they take many factors into consideration in determining the extent of their own participation in openings and in arriving at an opening price. Among such factors are the previous day's close, the balance between buy and sell orders, supply and demand, the orders on the book which indicate the probable trend of the market. So in other words, a specialist is using his book, which have on-hold orders for customers, retail customers and professional traders, and the entire market, giving him insights into the probable trend of the market. He also takes into consider general market conditions, overnight news affecting the particular issue or the industry group, and the specialist's own position. So he not only takes into consideration general market conditions, the probability of a trend based on the trend he can see based on the orders in his book, and he can also determine an opening price of a stock based on his own position. Now, this seems like a conflict of interest, yet that's exactly the way the market works. The specialist is at the heart of the market, and the specialist is the one who determines the future course of stock prices. It's as simple as that. Specialists sometimes will open the stock contrary to the trend indicated by public supply and demand. Now, this is really interesting because it shows to what extent specialists are able to manipulate legally stocks that they are in charge of, which is contrary to supply and demand. Let's read on. One stock opened on May 29, 1962, off 1.25 from the previous day's close, although in this opening the specialist sold 500 shares, indicating that before the opening the specialist had more orders to buy than sell. This normally would have been reflected in a price increase. In testifying about this kind of situation, Vanderbeck stated that a specialist would be justified in opening the price against the balance of supply and demand if he were anticipating further price movements and the conditions in the general market, in the stock, and the whole situation affecting that particular stock made his actions reasonable. In other words, a specialist can basically do anything he wants as long as his actions are made reasonable. Another area in which the specialist has the ability to affect prices involves the not held order, in which the specialist has the authority to withhold or execute when he deems it's propitious. If specialists were to hold a large number of such orders, they would have a reservoir buying and selling power at their command. And they could use such orders to create prices. The resulting market might be fair to all, but could not be deemed completely free one. We will talk a little bit more about not held orders. Basically, that is their specialist book that allows them to have a reservoir buying and selling power, which is the book that they know at which levels people are interested in buying or selling a particular stock. And it does give them a tremendous amount of personal insight and into trends and the market itself, which they take advantage of. One specialist testified that, as a result of his judgment of market conditions, he tries to adjust his inventory. His inventory, that's a very important word, and we're going to talk more about inventory when we get into how we track specialists and market makers in the market who are trying to either accumulate inventory or distribute inventory. Answer: if the market is going up, you try to be on the long side. If the market is going down, you try to be on the short side. Question: this from the standpoint of whether specialists are going to be able to make money from their dealer transactions? This is right. Both the accumulation and liquidation or distribution of inventories in anticipation of price movements permit the specialist to trade with the trend. Thus, in a rising market, the specialist may occasionally tend to purchase moderately on balance, and is permitted by the Saperstein interpretation to do so in anticipation of being a seller as the price continues to increase. And this really goes to the heart of what happens as prices and the cause for prices rising and declining. When the market is going up, they anticipate being a seller as the price continues to increase. So they are actually supplying. They are the supply to the demand for the retail trader. So as prices continue to increase, retail traders may not come into the market right away, but they may come into the market later on as the price continues to go higher. And it's probably the only market in which people will actually buy at higher and higher and higher prices, because their motivation is not to buy a widget or a commodity that they're going to be using in business. Their primary reason for buying at higher prices is to profit. So let's continue. Conversely, anticipating a decrease in price, the specialist may tend to become a seller on balance and take a short position in anticipation of being a purchaser during the decline. So not only are they supplying demand as stock prices go higher, And who controls stock prices? The specialists. So if stock prices go higher, they are distributing stock to the demand that is anticipated by the rise of stock prices. They tend to become a seller and take short position in anticipation of being a purchaser during the decline. So at some point in the decline, they become a purchaser, and they're the ones who stand at the heart of the market and create those V's in the market declines, because they step in and begin purchasing at that decline. And not only that, covering their short sale positions. In either case, the completion of the process, the specialist is in a position to act in some degree as a stabilizing force. At this point, a degree of depth in the market may logically and fairly be expected. So this is exactly this is how the specialist operates. They accumulate stocks at market bottoms. They liquidate or distribute inventory of stock as markets rally and go higher. And when they are when they have distributed all of their inventory and sold short, they take prices lower because they do have full power and full ability, full control over stocks that they are in charge of. And when stocks are at their bottoms after they've sold short and sold from their inventory, they are now accumulating stocks once again, and that's what makes prices eventually go higher, because it is in the specialist's best interest that they go higher after they have accumulated as much stock as they want. Now, if you think that this is somewhat antiquated data from 1963, this book on securities markets, Present and Future by McGraw-Hill from 2006, states that somewhat in response to criticisms that the New York Stock Exchange specialists are able to actually are not keeping up with the times. It says that specialists manage order inflows more efficiently through the use of something called SuperDot. It allows NYSE member firms to electronically transmit all market and limit orders directly to the specialist at the trading post or the member trading booth. What I want to draw your attention to, however, is that down here, another feature of SuperDot that greatly aids the specialist is the electronic book. We talked about the book previously that the Special Study Report mentioned. It is, in fact, one of the most valuable assets that the specialist possesses, because it gives them insight into where people are interested in buying stock and where people are interested in selling stock. So, for example, because they have full control and discretion over where to open a stock, they can determine that if it's in their best interest to take a stock lower and avoid a good number of stop orders that are listed in the book, they can take it. They can open the price below those stop orders before they start accumulating stocks. And in the same, if they're interested in moving the stocks higher, they have the ability to gap those prices higher above buy orders from traders who are looking at charts, who are breakout traders and so forth, who want to buy at a particular level. So, for example, if the stock is trading at 19.5 and a breakout level is 20 on the stock, they can open the stock at 20.5 and completely bypass all of the buy orders at 20. The Wall Street Journal in 2001 started talking about specialists. This is a pretty interesting Wall Street Journal article from March 12th of 2001. In a world that dot-coms were about to take over, what could the future hold for a system of stock trading so clunky it relied on human beings? Surely folks said a couple of years ago, in an electronic age, the specialists working the floor of the New York Stock Exchange were dinosaurs. Dinosaurs should be so hardy. The obscure functionaries who handle the murky task of matching buy and sell orders, keeping markets orderly, and deciding where to open a stock are scoring their biggest profits ever. Profit averaged $16 million per partner in just 9 months at one specialist firm last year, Spear, Leeds, and Kellogg. Wall Street giant Goldman Sachs Group, which had decried the NYSE floor system as a barrier to the market's competitiveness, now is rushing to acquire specialists. In fact, they own Spear, Leeds, and Kellogg. So why the turnabout? Part of it is that electronic networks, these are electronic communication networks or ECNs, have failed to reach critical mass of buyers and sellers needed to be a genuine alternative. But in addition, the specialists themselves have changed. They are increasingly exploiting their unique inside view of the markets to do highly profitable trading with their own money. As we've seen, though, they have been doing that for a very long time, at least since 1963 when the special study report came out. So they've been doing that already for a very, very long time. In the same article, he goes on to say, the main job of specialists, also known as market makers, is simply to match investors' orders to buy stocks with orders to sell them. But what if there are more orders to sell a particular stock than to buy it? Then the specialist firm has to step in with its own money and buy, or sell if there's an excess of buy orders. But the specialist isn't supposed to buy or sell if doing so would interfere with fair and orderly trading. In return for meeting these obligations, the specialist is allowed near complete knowledge of how much buying pressure and how much selling pressure there is. That's, as we mentioned before, that's his book. It's a privilege that any other market participant would die for. We certainly would. And in investment news, remember we talked about LeBranch. LeBranch is one of the largest NYSE specialist firms. Mr. LeBranch, who saw an opportunity when others were predicting doom, says he's not done astounding the skeptics. We've become one of the largest stock dealers in the world, says the 45-year-old chief executive. We are going to invest in technology and other businesses that fit our strategy of bringing order flow to us. This is a way in which specialists dominate the market. They do bring order flow. The order flow goes to them. Mr. LeBranch will once again have to be nimble. With 21.8% share of the daily trading volume on the New York Stock Exchange, LeBranch and Company needs to look elsewhere for rapid growth. It also has become a desirable target for an investment bank eager to get into the specialist business. But this is the most important section of this entire article. The Wall Street firm has come a long way in the 76 years since it was founded by Mr. LeBranch's grandfather as a specialist firm responsible for trading in 4 big board stocks. The fact that it has been in business for 76 years, that it was started by a grandfather trading in the New York Stock Exchange, means that they have an advantage that no other traders in stocks and options or in the market has. And once you realize the power that they have, and they are in fact at the heart of the market, you begin to realize how important it is to begin to follow what they do if you want to be successful as well. Let's take a look at a daily chart. Basically, at the lows, specialists come in and market makers come in to accumulate stocks. They begin raising prices because they have unilateral discretion over the prices of their stocks. They accumulate, they raise stock prices, and then they distribute at the top of the market. The same thing happens in a decline, but in a way, as the market goes up and down, you can see that there's both accumulation and distribution for short-term trading accounts by specialist firms. Now, specialist firms are allowed to have both a long-term trading account and a short-term trading account. So while they may be accumulating for long-term investment, their own long-term investment account at the very bottom of the market, as we see here on the left-hand side of this chart, they may keep it. They may keep the stock accumulated at that, or at least a portion of that stock accumulated as that market declined for a very long time until they're able to distribute it for long-term capital gains rather, at the very top of the market, which may last 6 months or a year or more, when they can actually sell the stock for a long-term capital gain. But there are also ways around that as well. Distribution, so they can allocate part of the stocks that they accumulate at lows towards their long-term investment accounts. Others are for short-term trading. So, for example, as they raise the market, distribution can happen at any time, and they begin to distribute stocks that they had in their short-term trading account for short-term profits. Once again, they lower prices, begin to accumulate stocks again, raise prices to distribute them. And if you look at the market in this way, you begin to see a pattern here in which, for example, we have equal accumulation, maybe equal distribution for their long-term trading account up here. They have short-term accumulation, short-term distribution, short-term accumulation, short-term distribution, and that's what causes the basic up and down movement of the stocks. However, as the market went higher, we've got a couple of distribution points. So now we've had 1, 2, 3, 4 distribution points and only 2 accumulation points on a short-term trading basis. So there's more distribution than accumulation. And so you could say that there was a clustering of distribution in this area and over this time period, which required the market to decline a little bit further so that they could accumulate more stock and accumulate more stock and accumulate more stock until they came to a high in which retail investors, because of the rise in prices, could not contain themselves any longer, rush in to buy stocks at the very high. The specialist market makers distribute those stocks at those high, and then the market drops sharply from that point because the specialist has distributed all of the stocks that they had in their inventory in either short-term or long-term accounts, and then are able to start to sell short into the market so that they can profit as the market declines. And the same with the market that is in a accumulation and distribution phase. We see that there is minor distribution but minor accumulation. There's quite a bit of accumulation as the market continues to go lower. But then on their short-term trading accounts, they want to distribute, so they raise prices sharply, get retail investors and professional traders in to distribute their stocks to them. Or they have a little bit of a longer rally so they can distribute additional stocks as they take prices lower. Generally, the middle of these trends means that they are trading for their short-term trading accounts. The major tops. So, for example, this top here, they are selling short and selling their shares for a major accumulation, which happens down here at the very bottom. And so a lot of these fluctuations throughout the middle of a trend are trades for their short-term distribution accounts, either accumulation or distribution. So again, we see here there's major distribution is from the lower end to the top end, and there's minor accumulation for short-term trading accounts as the market continues to go higher. That's what creates the fluctuations both up and down. So why is this course different than other courses that you've seen? Well, this course will convince you beyond a reasonable doubt that the market is legally manipulated by insiders who have total control over whether stocks go up or down, while fulfilling their dual mandate of providing liquidity and ensuring continuous trading in the stocks that they are in charge of. The fact that they are also able to trade for their own accounts in competition with the public actually helps us discover their objectives and helps us piggyback their buying and selling so we can be successful too. The primary mandate of insiders is to create a fair and orderly market, but nowhere is that actually defined. The truth is their goal is to merchandise stocks to investment managers, institutions, and the public. They do that by creating the market in them in understanding why investors buy or sell stocks at the heart of what specialists do. They understand why investors buy or sell stocks. If the market is going up sharply, there's a tremendous impulse by retail investors as well as professional traders who have a fear of missing out on a market that's advancing and end up buying as the market continues to go higher. Specialists and market makers will supply that stock to those traders and to those investors as the market goes higher. And when they run out of stock to supply them with, they will sell short and begin taking stock prices lower. And when they do that, they use just about any excuse in order to take the market lower. It's not unusual, and there's a lot of anecdotal evidence to suggest that the market is not random. One of those is market events or crisis and events that happen in which the market can actually take advantage of certain situations to drop or raise prices that give them that advantage. We saw on July 30th and 31st that the headline in the Wall Street Journal says U.S. is in the weakest recovery since 1949. The effect of that story caused a lot of people to sell on Monday, August 1st, and the market went down. And it allowed specialists and market makers to pick up stock at a reasonably lower price, and then soon after that continue to raise stock prices. The NYSE has its own publicity department, and it typically creates stories like this and disseminates them to the media that give investment managers and retail traders the reason for selling their stock. There's one more reason why they should sell, or one more reason why they should buy. If they want the retail investor or the professional trader or the institutional trader to buy stocks on Monday morning, they will place and suggest stories that are extremely bullish in the media. It takes a good amount of money to be able to look and receive data from the New York Stock Exchange, approximately $3,000 a month. But what that does is gives us an advantage at Tradingology in order to analyze the market data and the buying and selling activities of specialists. My name is David Valliere. For about 15 years, I worked in community service. In fact, here's an article that mentions me. I was the director of Utica Neighborhood Housing Services. I was the director of economic development for the city that I lived in. I was the deputy commissioner of urban and economic development for that city as well. After 15 years in public service, I decided to go into business for myself. And I'm the founder of Tradingology and the president and CEO of the investment research firm Strong Market LLC. I've been involved in the markets as a trader, educator, and researcher since 1976. The top 1% are the specialists. They make all the money, they have all the time, and are truly free. They are the elites, the privileged, the top 1%, the American royalty. We will never know what they know, and we will never have the money they have. But we can see them at work in the market and get insights into what they are doing. And what they are doing in the market is either accumulating or distributing stocks. Now, the New York Stock Exchange data that we receive, we put into a spreadsheet. And you see an example of that spreadsheet in front of you. It changes frequently, but it gives us insight into the distribution and accumulation of stocks but from a specialist perspective. And it gives us an idea of whether or not specialists and market makers and insiders are accumulating or distributing stocks. And in the next video, we're going to go into the spreadsheet, and I'm going to give you an inside look of exactly how we can track specialist movements in the market so that we can profit from them as well.